In the last video, we talked about looking at the market and trying to determine with a Sherlock Holmes detective attitude of what's happening in the market, what's really going on as far as price action and volume goes, and also to determine how to identify the potential for either low volatility environments or high volatility environments and what that consists of, and how to identify the potential for a high volatility environment occurring, as well as determining when a low volatility environment is entering into the market. It's absolutely critical that you get to understand volatility. Volatility normally will determine whether or not the market will rise or the market will fall. The earlier you can detect volatility as a key to future price movement, the better off you'll be. Almost no one teaches this that I know of. This came as a result of over 26 years of experience trading in the market. You won't find this information in very many places, if at all. As I stated, very small bars normally lead up to low volatility environments. When bars generate a larger trading range on a weekly basis or a daily basis or whatever time frame that you're using to study charts, it usually indicates that further volatility will come into the market, and the market generally falls. However, there are times in which volatility increases as the market rises if those bars also become extremely wide during a rally. For example, at the top of this market, in the upper right-hand corner, you can see a couple of bars here in which the range of those bars is extremely high, extremely wide. That indicated also an increase in volatility, and that's exactly what happened. A few days later, the market dropped significantly from there, along with extremely wide-ranging bars, and that is a clue that volatility will continue and possibly send the market much, much lower. So at those times, you want to either be cautious or you want to look for a short position in the market. Let's see, I'm going to back out of this because we're on a 20-year weekly chart for the SPY. And I want to show you how important this one signal that we talked about in the last video gave us, this high volume week in which the market barely moved at this price level with the confirmation of the low volume test that we saw here. That is one of my favorite setups. That is an incredible setup that has made me so much money. This is a high volatility period followed by an event of some sort, and then a retest of that high volatility period on lower volume. That is the key, one of the best setups I have ever seen. And let's look exactly how this relatively, it looks like maybe a minor event to you, but let's look and see exactly what happened after this event took place. That's the event way down here on the left-hand corner. Look at how small in comparison to this chart it looks, but look at the result. An incredible run-up in the market, absolutely staggering amount of wealth that was created if you were able to really pay attention to what was going on in the market at the time. And in relationship to this overall view of the market now, and you can see some of the gigantic bars that were actually being traded on a weekly basis through this market, you can see how relatively small, looking back, during this period, those bars actually were, how little volatility there actually was. And in this case, in this ETF on the SPY, you can now recognize the fact that the bars were relatively small, that volatility was relatively small as well, and that there was likely to be a rally coming in after this. And the very same thing actually happens with individual stocks. It's not limited to ETFs. You could have low volatility stocks that suddenly, once they find their footing, once they get into the point where the market for the stock is very, very good, similar to the SPY, they will continue to go up until they hit those high volatility areas. So, for example, I mentioned that one of the things that I looked for when high volatility was starting to come into the market was a period in which there was high volatility. Well, we started to see some high volatility back here in 1997, 1998. The market continued to go higher. We saw another bout of volatility here. The market went higher, and then there was extreme volatility throughout the peaks, and then the market sank dramatically after that, basically cutting itself in half, dropping by 50%, before we got some stabilization once again, and the market continued to go higher. Now, these are very, very long-term charts covering periods of years and even a decade or more in the market. On a shorter term time frame, you could have taken a look at these two candlesticks right here, in which the selling pressure was absorbed by buying, and you could have made a determination at this point that you'd like to go long the market. And you could have had participated in a nice little rally from 96 approximately to 111. So that was a fairly decent little rally that took place based on this type of analysis.